All right. Good evening, everybody. Let's go ahead and get started. Want to welcome you guys here. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just let me know that it is indeed working. Okay, awesome. Looks like we're up and running. Good to go. I'm really excited for this call. I've been preparing and excited to put together the strategy that I'm going to share with you guys. This is the uh, weekly trades from the scanner. But so we're going to talk about COT data and things like that. But specifically, the skill I'm going to teach you real quick is going to have profound effects on every single strategy that you ever trade. And so I'm really excited about this because I'm going to teach you a combination of martingale, but also anti-martingale at the same time that will help you amplify your winning trades and also cut losing trades going forward. So this is going to be really, really great. Webinars shouldn't take terribly long. Like I think we can maybe make this a 30-minute call. Just depends on how many questions we get and so on. But this is going to be really fun. So I'm really excited to jump into the content here and show you guys what I've been doing with the weekly trades to kind of amplify some of the profits that you can get from those weekly trades. So, all right, guys, let's go ahead and jump into this. Before we get started, as always, I need to remind everyone about the risks involved in the markets. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your contract size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, let's go ahead and jump into this. So I'm really excited to show you this stuff. So here's the deal. A lot of you guys have asked me a question recently. You've been like, "Hey, Steve, how are you getting bigger wins on the winning weeks with the scanner, and how are you like not losing a lot on the losing weeks?" This is what I've been doing. Okay, so really excited to share this with you, and I think this has application on every single strategy. So whether you trade the scanner signals or not, this could be used on anything that you do. So there's this. Let's first cover what martingale is, and then you can understand what anti-martingale is because there's the only way you'll understand anti-martingale is if you know what martingale is in the first place. So let's actually, let me see if we can pull up Chat GBT here. I want to see if we can have a good old conversation with Chat GBT on this. I think this will be really good. Okay. 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 One second, guys. I'm just going to get this all ready for us. Okay. Okay. Here we go. So let's go ahead and ask ChatGPT a question. So let's ask it, what is martingale with Forex trading? And this is going to give us a quick little answer, hopefully. So we'll just read the top here. So martingale in Forex trading is a position sizing strategy where you double your lot size after each loss, with the idea that eventually a winning trade will recover all prior losses plus a profit equal to the original trade size. So pretty straightforward, right? Very similar to the overnight trading strategy, except what? With the overnight trading strategy, we don't double our lot size. So traditional martingale requires doubling, which doubling is a troublesome game. Like I'll just tell you right now, you should not be doubling lot sizes after successive losses, really ever. Statistically speaking, I've read some books on this. Usually after like the seventh or eighth doubling, it becomes there's like a bell curve that becomes statistically irrelevant. If you were to you'd almost be better off just trading an edge at that point than just going. This is a hopefully not too technical, but basically what happens is you get diminishing returns if you have to go over like six or seven doubles, and you'd be better off just trading an edge in the market and developing an entirely different strategy than if you were to just double your lot size after every successive loss. That's actually one of the reasons why we stop the when we trade the overnight trading strategy. It's one of the reasons why we stop after day six, because statistically there should be one there should be some kind of breakout within 6 days. And then the other reason for this is when you start doubling beyond, 6 days or multiplying beyond 6 days or so, you get a really diminished return because you have to protect and preserve margin in your account in order to make those, day 7, day 8, day 9, day tens and beyond. It becomes worthless at that point. And so that's why we don't double, because if you were to double, you don't have very far you can go. And I think even was it Roger last webinar? He mentioned something about like the roulette table. Like if you were to double your money on the roulette table, which obviously that's the only way you could do it. Yeah, you're basically 6 or 7 doubles away from ruin and blowing up the whole thing spoils after 6 or 7. So it's not even worth it at that point. Zoom user says, what's an edge? So an edge is basically the reason for entry. That's all it is. Okay. So, like, let's say you build a strategy and the strategy is to buy like a simple crossover SMA, EMA strategy would be like if the 50 EMA crosses the 200 EMA above, then that would be a signal to buy. If the 50 EMA crosses below the 200 EMA, then we go ahead and sell, right? That's an edge. Okay. And so sometimes you don't, so a lot of strategies don't even need an edge. So it's an exponential moving average. So like an EMA is just like a moving average, like it's an indicator on your chart. Okay. SMA, simple moving average. EMA is the exponential moving average. They're just different oscillators on your chart that you can put on. And so a lot of beginning strategies are developed like that. I don't trade any of those systems. The last time I traded a crossover strategy like that was like 10 years ago. So yeah, I don't do any of that kind of stuff, but that's a pretty common retail way of trading. Um, so an edge is basically your reason for getting into a trade. And so technically, and this is the thing that I've been trying to tell people for a long time now, is you don't even need an edge to be profitable. Like even the overnight strategy technically doesn't have a significant edge other than the fact that you're just setting up a breakout trade before London opens. It's a purely math strategy. It's all about like, does the market go up? Does it go down? And if it goes up far, we're going to take advantage of the buy side. If it goes down far, we're going to take advantage of the sell side. That's the overnight trading strategy, right? So, okay. Cool. Let's go ahead and continue on here. So this is martingale, right? This is a very dangerous there's system. It really is. So a lot of people shy away from this and they'll immediately shut off. Like when they hear you mention the word martingale, it's like the M word in trading, right? You can't use that word um, because it is risky business. So what's the opposite of martingale? And that would be considered anti-martingale. So the way I trade anti-martingale is basically when you scale into a winning trade. So instead of adding to a successive loser, what you do is you add to a successive winner. So let's say you've got a winning trade on your hands and you go ahead and add to a winning trade. Now let me ask you guys a question while we're on this topic. Let's actually go to the charts here. Let me ask you guys a question. So let's say that you're trading a strategy. How many people would you say, and you don't necessarily need to answer this because I think I'll answer it real quickly, but do most traders add to winning trades or do most traders add to losing trades? What's the tendency? And I would say, and you can answer if you want, but from what I understand, the average retail trader is more likely to add to a loser than to a winner. Why is this? And the reason for this is because if we add to a losing trade, there's this hope, and I think it is somewhat of a false hope that the trade could turn around. Okay. We took a short position on this USD franc trade. This is our best trade this week. We sold this, at the beginning of the week. This was one of our scanner signals, right? And we sold here. And most traders would probably not add to this as a winner. Like probably most traders, I'm guessing would probably just not you guys necessarily. I'm just saying, like, if I were to have given this signal to a bunch of traders, they probably would have just been like, okay, I'm going to take a trade and see what happens. And a lot of traders probably would have been like, oh, I'm up, it's Thursday or it's Wednesday, and I'm going to take, half my position for profit, or I'm going to take the full thing off the table because I need that profit. But if you've got a losing trade, we've had a couple of losers this week, right? Namely, the Euro Kiwi was been that was a terrible signal, unfortunately. Um, a lot of traders would add to that loser, right? Um, it's just a natural tendency that comes into the market. Sometimes I get traders who will say, "Hey Steve, are we just closing out half the winners this week, or are we closing out half the losers, or I'm just going to close out half the winners and let the full losers lose?" And see that, to me, it's just like we're pre-programmed to do that, because that's the question I get a lot from people is I'm just going to hang on to these losers, and that's not a good practice to get into, right? You actually want to train your mind to do the opposite. Like, oh, this thing is winning, how do I put more on this winner? Oh, this is losing, let's put less on this, okay? So it actually takes some real mental fortitude to change your mindset on that. Okay, so let me show you the application of this. This is the part where let's get right into the whole point of this, the call, like what we're going to do here and how you're going to make money with this. So, one is martingale. So, martingale, we use that already with a type of martingale with the overnight strategy where if you have a losing day, you go ahead and go up the sequence multiplier, you add to the position so that if it is a breakout day, you can make a lot more on that winning day. Now, so how does it work with the weekly trades though? With the weekly trades, we don't close out trades during the week unless they hit their stop losses. We basically judge the results on a week to week basis. Okay. So if you have a losing trade, um, it doesn't matter because maybe you'll have a winning week with the other trades. But by Friday, you're going to know if you're going to have a winning week or a losing week. In fact, last I checked, let me see how we're doing. Yeah, they've been all over the place. Like, I don't even know if we're going to have a winning week yet with the weekly trades because earlier today I was up a lot more and now I'm down a little bit on the weekly trades. So who knows? So yeah, it's kind of a mixed week to be honest. But anyway, that's besides the point. What I'm trying to say is by the end of the week, by Friday, you're going to know if you're going to have a winning week or a losing week because you're going to close every single trade. The winners, the losers, everything's just going to close out, right? Okay. So So if you have a losing week, one of the things that I've been doing, or if I have a losing week, I'm going to go in on Sunday night with the new trades and I'm going to slightly increase the risk by a tune of 1.5. So I'm going to use a 1.5 multiplier on those trades. So I'm increasing because I'm guessing like, hey, since I had a losing trade or a losing week, let's see if this week is the winning week. And I want to stack the odds in my favor if this is going to be a winning week. Usually, so far since October, I haven't had more than two losing weeks in a row. I've always had a winning week within 3 weeks. And so I feel pretty good with using a martingale on a week to week basis, so long as it's controlled and we only increase at the tune of 1.5. Okay. Now, here's the cool part, like the really cool part. So, what if you were to, so everybody already does like the simple, like, here's your signal to sell the USD franc at the beginning of the week. Here, I'll go ahead and label this here. So, you got the sell at market order because you got a strong sell signal on the scanner. Okay, but what if you were to come in here and every half an average daily range or so, you separate, you add more positions. Okay, so this is anti-martingale. This is where you're adding to winning trades. Okay, so you got a sell stop order over here. Okay, and I'm going to go copy that and I'm going to put another one down here. Okay, and so on. Copy, paste, put another one down here. So basically, you're adding to the winning trade. Now, here's where it gets so cool. This is like the coolest part because there's a relationship between these trades and what happened in the past week. So obviously, if you had a losing week last week, you need to get your money back this week, but there's lots of ways you're going to get your money back. One method is through using just martingale, meaning that your trades are going to step up in the multiplier by the tune of 1.5. But the anti-martingale is where I think it gets really, really cool. So what you're doing here is you're actually scaling into a winning trade at a higher multiplier. See where we're using martingale and anti-martingale at the same time. So if not, I'm going to re-explain this. So basically what's happening here is, let's say you have a losing week and you were trading, just like, let's say you took this trade at a zero point 0.1 contract or 0.1 risk or something like that. So a tenth of a percent risk, something small, nothing huge, but you lose on that typically if you're going to have a losing week, you're not going to trigger into all of these sell stop orders, because the only way you're going to the only way you're going to get into these sell stop orders is if you had a winning week. That's the only way you're going to get into those. Okay. So you're going to avoid a bunch of trades if the market just goes the wrong way. Like if the market's just like, hey, those signals stink, we're going to go the other way this week instead. It can do that. It can just go the wrong way. And you're going to lose on your market order trade, and that stinks. But then the next week you have an opportunity to come back. But now what you're doing is, instead, the second week you're coming in, instead of risking 0.1%, you're risking 0.15%. So you're slightly increasing that risk per trade to the tune of, like 50%. You do a 50% increase in the lot size, and that's for each one of these. So now you're doing, like right here, you're doing 0.15% on the sell stop as well. And then you're also doing 0.15% over here now. This is just an example too. You can do this a couple of different ways, but I'm going to give you the actual strategy sheet so you guys can copy this exactly the way I'm doing it. So now what happens is, if the previous week was a loss and you only triggered into one or two trades, those trades can lose. But if this week is the week where everything just breaks out perfectly, everything goes in the direction we want it to go, and it's a big breakout week, every signal just kind of works out fantastically. We have a couple of those weeks, right? And now you can do that at an increased position size. But not only that, but you've increased the position size on successive sell stop orders or buy stop orders in the direction of the signal. Right? So now what's happening is you're recovering your losses from prior weeks at a, quite frankly, frantic scale. Like you're doing it so super fast, light speed. You're fixing those trades because you've got trade losses on your hands from the previous week, but you're recovering those losses. You're recovering those losses because, one, you're using a martingale, a controlled martingale, like a very controlled increase in risk that's the following week. But the thing that makes this thing very potent is the fact that you're going to increase on winning trades. So you're adding to this on a winning week. And then also the trades that do lose, they can just lose without triggering into all of those sell stop or buy stop orders. Now, there's going to be a couple of times where you're going to trigger into several of these and they go the wrong way. But by and large, if you're setting this up every week, you're getting the best of both worlds, is what I'm trying to say. Let me look at some of your comments, and then I'm going to re-explain this in more English over again if I need to. Okay, so this is, let's see, I've got right here. This is great. Instead of increasing from the beginning, I've increased on Sunday from the start and lost more that week instead of recovering from losses. Exactly. Let me comment on this.
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders, and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
Yes, exactly. So yeah, you can increase the risk and still have another losing week, right? Like you can have a losing week here, and then the second week it's still another losing week. We've had 2 weeks in a row of losses, haven't we? Like we can't guarantee that the next week is going to be a winner either. So because of that, you could still lose money the second week that you increase the risk. But what's happening is if it's a week where everything takes off in the direction that you're hoping it goes, um, now you're getting the obviously that's an increased step in the multiplier, but in addition to the fact that it's an increased step in the multiplier, you're also scaling into more and more winners on the way. And so it makes this more and more lucrative beyond the fact that you've just used a martingale. You're also using anti-martingale on the way down, which is helping you out a ton. Okay, cool. Let's see. Let's continue our look at this here. Um, exactly. Paul says, looks like Israel's attack on Iran has a lot of pairs jumping around like crazy. Yeah, I wouldn't be surprised that's the big reason for them jumping around right now. Not much we can do with that. It's not something we can control, but yeah, I agree. Daniel says, I'll need another go through on this. Might have to rewatch this. Roger says, we've had six straight weeks of losses twice in the last 2 years. Yeah, well, yeah, I mean, yeah, so that's before the last update from the scanner, right? Like that's, in the last 6 months since we made a, since the last update on the scanner in October, I don't think I've had more than 2 losing weeks in a row. We've always had, I mean, past results are not indicative of future results either. So you've got that. But here's how you're going to manage that in case that does happen, Roger. So if you go look at this, I'm going to give you guys this right here. Here are the rules for this. So if you want to trade this version of the weekly trades, here's how you're going to do it. Um, so since you're going to be taking multiple trades, a total of what I've been doing is one market order and then two additional pending orders on each trade just to keep it simple. So a total of 3 trades in case the market does break out in the direction you want to go. Um, so here's how this works. So, okay, let's look at the overview. This system is designed to compound into winning trades using anti-martingale scaling, which is what we just talked about, while recovering from losing weeks with controlled martingale sequence multiplier, all based on weekly institutional caught trade signals from Zscanner. Okay, so basically, again, you're using martingale and anti-martingale at the same time. You're getting the best of those two worlds. Um, and we're gonna get to that part. How far up and down should you place them? We're gonna get to that in just a second. So here's the trade setup. So you take each signal in the direction of, like normal, you're gonna do a market order entry on Sunday night or Monday morning when the new signals come out. You're just gonna do that per usual. Um, you're going to start at a 0.1% risk. Okay, that you can do what you want to do, but this is a good place to start. I think it keeps it's a good amount of risk if the trade goes in the direction we want to go, but if it doesn't go in the direction we don't want it to go, then it's not the end of the world. Okay. Scaling entries. So you're going to place 2 additional pending orders. So this is where it breaks off from the normal strategy because the normal strategy is just one trade in each direction and that's it. With this, what you're going to do is place 2 additional pending orders, buy stop or sell stop, depending on the signal direction. Okay, that's pretty straightforward. Each pending order is placed a half an average daily range apart from the previous one. Okay. So you'd have to go look this up on the website, but on the scanner, we have the ADR column. And so a half an average daily range is the separation from each one. So if you're trading, like, for example, the USD franc, I believe the average daily range is close to 100 pips. So let's just call it 100. All right. So you would place a market order, and then 50 pips away, you do another sell stop entry if it were a sell trade, which this week it is. And then another 50 pips away, you'd have another sell stop order ready to go. Okay. You're gonna use so that when you ask about spacing, how far should you put them apart? That's what I've been doing is a half an average daily range apart on each one. So if you think about it, you got three trades, an average daily range total. You've got the market order just at market in the direction of the signal, a half an average daily range. From that, you've got another sell stop order, and then another half an average daily range for a total of one average daily range. You've got the final order is what you've got. So it's a total of three trades, one at market and two pending. All right. Each trade has a full average daily range stop loss. Typically, we've been doing with just the normal strategy, 2x average daily range, and that's helped with not triggering into trades. What I want to do with this one is just do a 1x average daily range for the stop loss. And the reason for this is because let's say the market goes the wrong direction for like a day or two and you get stopped out on the market order, you still have a chance for redemption on the week, so long as those other pending orders trigger by the end of the week. So to me, because of that, and because I want to keep the risk small, I'm going to just go with one average daily range for the stop loss. And that's going to make it simple because the average daily range is already indicated on the scanner. So if it's 100 pips, then each trade has a 100 pip stop loss, right? So you'll still need to go through the lot size calculator. You'll still have to plug in 0.10% risk. You'd still have to put in the average daily range as your you'd still have to put the average daily range as your lot size. And I can show you how, we got time. So I can show you how to do that real quick. It's super easy. So I'll show you how to do that on the lot size calculator. Okay, so let's continue on here. These pending trades only trigger if price moves in your favor, allowing you to scale into winners using the anti-martingale approach. Okay. That's the whole spiciness of this. If the market does not go in our favor, sure, we're going to have a losing week, but you're not going to trigger into all of these trades, hopefully. I mean, it's possible and things could trigger the wrong way. But if that happens, then you'll just have to knock them out at their stop losses if that happens. And have to come back on another winning week and at using the martingale to increase the multiplier going into the next week. So okay, total possible entries per signal, one market order plus two pending orders equals three trades. Each trade carries the same calculated risk percentage for the week. See the sequence multiplier below. Risk control and weak martingale recovery. So this is the martingale side. We just talked about the anti-martingale. So the martingale side looks like this. If all trades for the week result in a net loss, um, yeah, so net. So you could have like two winners, but then five losers, and it doesn't, you still had a net losing week, right? So if you lost for the week, you will apply a sequence multiplier for the following week. This adjusts your base risk per trade to recover more efficiently while staying within safe boundaries. Okay, so this is how it would work. First week is the default multiplier of just 0.10% risk. That's a tenth of 1% per trade on the three. So technically, each currency pair would have a total risk of like 0.3%, like a third of 1% on your first week. Okay. And that's per currency pair. Again, sometimes you get like seven signals, eight signals. And so you technically would be risking like eight times 0.3, which would be like a little over, it'd be between like 2 and 3%, something like that total on the week. So you got to keep that in mind. Not likely that you would lose that because the all three trades would have to trigger on each currency pair. And anyways, so anyway, a lot of considerations to make. Okay. Then what you're doing is if you had a losing week, the next week you're now risking, this is the martingale side, you're risking 0.15% per trade. Okay. So you're increasing the risk after a losing week per trade. And what this does is when the anti-martingale side comes into play, and let's say it's a winning week and things go in your favor big time, you're now not only capturing a lot of pips, but you're capturing more pips on multiple trades at a higher multiplier. So you can see how fast you can like you can be rapid recovery. It's going to be fast. Then if you lose another week in a row, you'd move up to the next step in the multiplier, which would be 0.25225%. You could just round that to 0.23 because again, we're just using a 1.5 multiplier. Then if you had to go to a week 4, so that means you lost 3 weeks in a row, then you would go to 0.34% per trade, and cap it at 0.5%. I honestly don't think you'll ever need to go here, because I think you're going to get a win within those first 4 weeks. You're going to have a winning week. That's going to be a crazy awesome winning week within 4 weeks. The markets are have a way of having consistent breakouts. Like a whole month of no breakouts is absurd. Like there's going to be some breakout pairs throughout that month that are going to just make your month for you. Yeah, I'm certain that you're going to hit a couple of really big wins there. So let's continue on here. Maximum risk per trade is capped at 0.5%. I honestly don't even think I'd go to that. I think I would just stay at week 4 as many times as I needed to if I had to. That's probably where I would stay. I don't think you'd even have to go there. Why it works: anti-martingale scaling capitalizes on strong market moves in your favor by adding to winning trades only. Okay, so that's where you get the side that most traders neglect. Okay, a lot of traders don't do this part, and because they don't want to add to winners. This is where you get to add to really strong market moves. And then you got the martingale recovery, which is systematically increasing position size after losing weeks to recover drawdowns efficiently. Weekly frequency keeps things structured, stress free, and aligned with institutional money flows via COT data. The other nice thing, so the reason why this is good is because I've tried to do this like on a day to day basis or even on a trade to trade basis, and it's really hard to use anti martingale and martingale on like on a day to day basis. There's so many trades you have to add and take away and move around. So if you just apply this to a weekly trade setup like we do with the weekly trades, this will keep you busy enough. Like it'll take a little extra work probably on a Sunday night, but then you don't have to do anything the rest of the week other than just close your trades on Friday. But this will take you more time than just simply taking the trades and being done. Like you're gonna have to go through the multiplier, know where you're at with things, and then you're going to have to place those trades a half an average daily range apart. You got to put in a stop loss for each one of them. I mean, you're looking at a total of, if you think about it, like let's say you have a week where you get 7 signals off the scanner. That's 7 signals times 3 trades, 21 total trades that you're looking at that you'd have to individually go set up. Now, you only have to do it once, which is great, once at the beginning of the week. And that's why I say at the end here with this last bullet, I think this is all you can try to handle. Like I've tried to do this on a day to day basis with different strategies, and it's really hard. So I think this is perfect because you're capturing those big week long moves, using anti martingale to capture those moves in a big way, but without having to reset things every single day. It's just one time at the beginning of the week. So let's see. Let me look at some of these other questions, and feel free to get me questions in the chat box as I go along here. Daniel says, "Is this given the scanner? Is this giving the scanner gives the same pairs each week, or would you keep trading the same pair given a lost week?" Yeah, yeah. Sometimes, obviously, the scanner is going to have multiple signals that were on the scanner from the previous week. And obviously, you'll close those trades on Friday. And then if the scanner reproduces the same signal the following week, you'll just go ahead and reset again. Sometimes the scanner will get trades a little early. Like it might say, hey, sell the USD franc this week. And what if this isn't the week where the USD franc actually goes down? What if it's next week? So, and it'll repeat that signal again. You'll lose that first week, but maybe the second week you can get some redemption with that trade. And what's cool is you can get that redemption in 2 different ways. One, because you're using martingale to increase the overall lot size across every trade. And then in addition to that, you've got the anti-martingale side, which is scaling into the winner throughout the week at a bigger multiplier, which is beautiful. Like that's kind of what we do with the overnight trades, because with the overnight trades, it's really simple. Like you've got a big take profit, right? Huge take profit, 1 to 5 times what you're risking. And then you're also increasing, at a schedule, your position size. And then when that thing takes off, you can get those big profits, because those you've amplified those pips as the thing takes off. So you're basically doing the same thing here. Um, but I actually think this is even better because you're it's not just capturing the pips. You're capturing those extra pips with an anti-martingale system that's designed to scale into more trades, not just use martingale to on a week to week basis, but you're getting that anti-martingale zest right there that's increasing those those profits on those ones that just run away. When they say like this stock is going to go to the moon, or that pair, for forex pair is going to go to the moon or something like that. Sometimes that happens, and when that happens, you're capturing it at more lot size, and anti-martingales. You're adding to a winning trade. Like, yeah, it could be really really awesome. Okay, cool. So I think that puts us in a really good spot. Oh, by the way, here's the link. So you guys can have this. Here's the link to the strategy. So everybody bookmark that, save that for yourself, so that you can review these rules outside of the recorded call. Obviously, this is recorded, so you can come back and watch this later. But yeah, there's the link right there, so you guys can go check that out. What other questions you guys have? While you guys are putting in your questions, I'm going to show you how to calculate your risk on each trade. Let's even do a demo together on one trade. So you know how to take these trades as if I were you doing this starting Sunday night. Okay. By the way, I just want to remind you guys, you can use this martingale plus anti-martingale stuff on like any strategy, not just the weekly trades. You could use this for really anything. Anything that takes advantage of breakouts and massive moves in the markets, anything on a schedule, you could use this. So, yeah, absolutely. And there's so many different ways you could use this. This is actually, it took me a while. Like I had a mentor that was doing this 13 years ago, and at the time I had no idea what he was doing, and it took me years to figure out, like, oh, that's how he tips the scales in his favor. It's like, oh, okay, a lot of people just who use martingale systems just stop at martingale, and that's it, and they find a lot of inconsistency with that. But if you can combine the two together and get them to work, it's amazing. Like, I think what we've done right here is the perfect recipe to succeed with that. So let me show you how to do this. Let's go over to the free tools over here. Let's go to the lot size calculator. So let's say this is the first week. Let's do the USD franc as one of our trades, because that is one of the trades we took this week, right? Um, yeah, you can even use it with the overnight strategy. Absolutely. Okay, so if I'm taking a trade off the weekly strategy using the rules that I just gave you guys, pretty straightforward because we're using an average daily range for the stop loss. And so all you have to do to figure that out is you just have to go to Steve's scanner, and you can find out what the average daily range is over here. So let's go ahead and do that real quick. Wow, everything took a absolute dump. That a lot of news, a lot of news. Okay, so let's find the USD franc. 57 pips is what I have right here. Okay, so I thought it was 100 pips, but it's 57. So 57 pips is what you would put in over here on the lot size calculator as your stop loss. Okay. Let's say it's a $100,000 account. You don't worry about the pip size. That's already done for you. I'm going to do 0.10% risk per trade. And then I click calculate. And so this is saying like, hey, you're only risking $100, and it's not a lot. Like these are not huge, huge trades, especially in the beginning. It's designed that way. If the market takes off in your favor, yes, you'll make a lot more money. But if it doesn't really take off at all, or even goes against you, you can keep that loss pretty small, so that the following week you can come back bigger and better and faster and stronger, right? So yeah, it's a smaller trade. You're just doing a point 0.14 contract, 14,000 units, that's pretty much what you're doing. And that's per trade, right? So if you were trading the USD franc, that would be a total of 3 trades. So what you would do is you would come in here to the USD franc and you would set up each one of these. So let me give you, let's actually delete this. Let me do an example here. Let's say this is the beginning of the week. Let me actually log into a paper trading account with TradingView, and I'm going to do this with you guys real quick. Okay, let's do a quick little example here. So I would just take the trade at market, and I can do this. This is just a paper trading account. So let's just say the signal is to sell. So you'd be like, okay, according to my lot size calculator, I got a 57 pip stop loss. My units are 14,159. So I'd be like, okay, that's great. 14,159. And then a take profit. We don't use the take profit, right? So don't even worry about it. Just don't even click it on. Stop loss is 57 pips because we're using an average daily range. It's right there. So we'll just go ahead and that's it. So you'd be ready to, it's $100 of risk, pretty much ready to go. So you'd hit sell, and then that would be the first trade. Okay. Now you got to do 2 more trades, right? So half an average daily range. So 57 divided by 2 is going to be 28, right? 28. So about 28 or 29. So I'm going to go 28 or 29 pips beneath this. That's going to put me like right there. And I'm going to place another trade. Let me actually put a line right there. Okay. And below that, I'm also going to do another trade as well. So these are, again, these are placed a half an average daily range apart. So like that. Okay. So now I'm going to do this again. I'm going to do another sell, but this time I'm doing a stop order, right? We're always doing stop orders on the weekly trades. Um, and well, when we're doing this anti-martingale, you're going to use stop orders. And we also do it with the overnight trade stop orders, right? So the entry price, I just drew it up right here. I use this little horizontal line to draw it up. And so I'd put in, okay, my price is going to be 0.80366. That's my price right there. And then I'd put in a stop loss of 57 pips. Again, it's also a half an average or a full average daily range stop loss. And I got my price in, I got my units are still copied over from the previous trade. It's ready to go. I'd go ahead and click sell, stop, and that's got my sell stop order ready to go. And then I do this same thing again for the final trade, do another sell stop order, and I would put in my price of 0.80077. And then I would do a stop loss at 57 pips right there because that's the average daily range. I'm still risking about $100 on this trade. It's a total of $300 across all the trades, right? Like it's zero point 0.3, it's a 0.3% of the entire account, right? And then I'd click sell and it would be ready to go. And so now this one's done. Now I'd need to do this on every single signal for the week on Sunday night, but then I'd be done, right? So I've got my sell order right here at market. I've got another sell stop a half an average daily range away, and another half an average daily range away. Down here, I've got another sell stop order. So if this market decides to go up this week, let's say it decides to go the wrong direction, it's going to stop me out, but I'm only going to lose how much? $100, right? On one trade. And not fun. We don't want to lose, but it happens, right? So it's just whatever. Then if this trade continues lower, let's say it actually doesn't go the wrong way. Let's just say it just goes straight down like kind of this one did. It just went straight down this week. You're going to trigger into all 3 of these and you're going to make a lot of money on all 3 of them, right? Because you're getting all the pippage, right? Is that a word, pippage? You're getting all the pippage on the move down, that distance, and you've got it amplified because you got 3 different trades going. So that's that anti-martingale working for you. And then the other thing that you've got working for you? Is any increase in the lot size if you had a previous? Well, I mean, you've got your 0.1% risk on each trade, but like if this were a week where you had lost, a week ago and you're increasing the risk this week and this thing takes off in your favor, wow, you're gonna be cooking in the right direction really nicely. Okay, really good. Uh, Pippity. We could do pippage. Yeah, yeah. Let's do pippage. Like, yeah, that'll be good. That'll be good for our anti-martingale stuff. We'll call it good pippage. Uh, that's awesome. Cool. So this is how you would set it up. Okay. Once this is set up, you don't need to do anything the rest of the week. Okay, you're done. All right. So you could walk away from this and you're just done, done, done. So um, what other any questions? Did I miss any other questions? Looks like some of you were going to ask the same question. But yeah, you'd have to do this on all of the signals that you get. So if it's a week where you get 5 trades, you do it on the 5. If it's a week where you get 8 trades, you do it on the 8, right? Um, and so the hope here is if it's a bad signal, it can just go the wrong way without triggering the rest of these. On occasion, it's going to trigger a couple of them or it's going to trigger all of them and still go the wrong way. That's still going to you can't avoid it, right? Like sometimes it's going to happen. It's not as likely, but it could happen. And if it happens, it happens. Hopefully it's not on every single pair. Oh, by the way, another thing I was going to say too, trailing stops might be a good idea on this too. Okay? It's going to help limit even more risk. So if you wanted to use a trailing stop, I wouldn't necessarily be opposed to your use of a trailing stop. For a week long trade, I think the trailing stop could actually be a good risk management tool. But it's not required. You don't have to do that. So, could we put a take profit? You can. You could. But I'm not going to. Um, I'm not going to put a trail. I'm not going to put a take profit on here. And the reason why is because there are going to be some weeks where this thing just absolutely takes off. You know, the term go to the moon. When these go to the moon, I don't want to do take profit. I don't trust myself enough to be like, oh, I think I know the top. I'm not going to speculate the top on these weekly trades because I've seen some of these just absolutely tear through the top. What you think is the top is actually not the top, and it goes, 3 times what you thought it could go. So I'm not saying take profit won't be helpful. I think it could be really good. And you could use a 1 to 3 target if you wanted to. So that would basically mean that you're using 3 times the average daily range as your take profit. And I think you'd be fine to do that, but I'm just not. Um, it's just I think with it's not something that most retail traders are familiar with to not use a take profit, but I think it's the very thing that could be it could help you in so many ways to just not use a take profit on some of these trades because um it's very healthy to start holding on to winners and just get in the habit of holding on to winning trades. So but yeah, I mean, if you put one that's 1 to 3, I think you'd still be very, very successful. I just think you're cutting yourself short on the winners. Um, Yeah, Roger says election night was like that. The whole basket went to the moon. I passed phase one in one night. Yeah. Yeah, we want some of those to just blow off the top. Let's see. Somebody said how do you use a trailing stop on TradingView? I'm actually not familiar how to put a. Does anybody know if you can? I actually don't know if you can put a trailing stop on TradingView. Um, I know how to do this on a Wanda and Trade Locker and so on, but I don't know how to do it here. So in fact, I don't know if you can. Let's ask the Chat GPT. Can you put a trailing stop on a trading view trade? Maybe you can. I don't know. Let's see. Oh yeah, yes you can. Let's see. Awanda, Forex.com, Interactive Brokers. Open the trading panel, connect to your broker, enter trade buy or sell. In the order ticket after the trade is live, click to take profit, stop loss settings, enter enable trailing. Okay. So let's go here. Let's go down here to the trading panel and let's edit. Am I missing how to do this, guys? I'm sorry. I'm trying to figure out where to dock to the right. Stop loss enables quantity and risk. Let's see. Um, protect position, close position, reverse position, trading settings. I'm gonna have to figure this out, guys. I don't know why. I'm not sure why. Let's go protect position. So you got all your stop loss settings here. You think the AI is high? I have caught it sleeping. That's for sure. I have caught this sleeping for sure. So I don't know, guys. I'm gonna have to figure that out. But yeah, give it a shot this week. Definitely do this in a practice account. This is still something that a lot of you guys are used new to. Here's when I would go live with this. So before you go into like a prop firm challenge or like using your own money to trade this, here's what I would do. Okay. My plan would be to at least close out one or two successful sequences with this. So that's going to take several weeks, right? So, I mean, if you have just a winning week period, I guess that's a successful sequence. But I would wait till you have a losing week with the trades. Okay. Have a losing week and respond to that loss the following week with a increased step in the multiplier. And then if that's a winning week and you went through the process correctly, then maybe you might be ready to go. But maybe go through at least two of those. So it could take me maybe a month. Could take a month to get there, or at the very least, I would give this several weeks of practice and commitment before you jump into it. The worst thing that can happen is you can jump into a strategy that you're not very familiar with, that you don't really have the commitment to practice or the commitment to stay true to it, and then you just kind of give up with it, which I am guilty of. That's why I'm not blaming you guys. I'm just guilty of that myself. So and I've learned from that over time and I've coached people that. So that's why I say that that's a possibility. So make sure that you're totally committed to your system before you go live with it, and then you'll be just fine. All right, guys. I think this is great. I'm excited for you guys. Let me know what your progress with this is. I'm really excited to hear about it. But I'll let you guys go. Have a fantastic rest of your evening. Again, as a reminder, we don't have classes tomorrow. This is the last class of the week. So thanks for coming, guys. And we will see you guys on Monday. Thanks for coming.